Hello everyone, and welcome to our webinar today, GovCon Accounting 101, Direct versus Indirect Costs. NeoSystems is excited to be presenting this webinar in conjunction with SCORE. And this is a first in a series of webinars. We're going to be doing one on February 18th, contract types and pricing, and then we'll be getting into understanding DCAA, and then finally into cash management. And these are all leading up to a workshop that we'll be putting on together with SCORE on April 22nd at their offices. The workshop itself will be similar to the content, but we'll be going into greater detail. It'll be interactive, so you can ask questions such as, how does this apply to me? It'll be a very interactive workshop that we'll be putting on April 22nd, SCORE and NeoSystems. Taking a look at our agenda today, we're going to do some brief introductions where you can get to know us a little better, and then we can get to know you a little better. Then we'll be diving into the cost and pricing principles that go into government contracting. And then we'll take it an even level deeper, going into the direct cost, the indirect costs, what make them up, and everything. And then we'll open it up to your questions. If at any time you have a question, please feel free to type your question into the questions box. So a little bit about us. First, a little bit about SCORE. SCORE, as many of you know, it's free and confidential business advice for entrepreneurs and small businesses. They're a nonprofit dedicated to entrepreneur education. It's all volunteers, so that you have this face-to-face interaction with a mentor, and they also have the low-cost workshops like the one I mentioned before. Everything we're doing today is through the Greater Washington, D.C. chapter of SCORE, which has been mentoring where you can get mentoring from over 50 successful executives. And when you add all that up, it adds up to hundreds of years of relevant experience. For more information about SCORE, please feel free to check out their website at the URL listed below. And a little bit about NeoSystems. At NeoSystems, we focus on the back office. We're talking about accounting and finance, IT, HR, or human capital, depending on what you want to call it. And one of the things we do is we focus on government contractors, nonprofits, companies that are in high compliance industries. At NeoSystems, we have the largest team of Deltek accounting system experts in the industry. So for those of you who are familiar with Deltek, they focus on building accounting software, project-based software for government contractors. We have multiple locations. We have the one in Tyson's Corner where I work, as well as Sean Chen, who I'll be introducing briefly. We also have our newest office in Orlando, Florida. And I mentioned IT, and we do hosting. We have over 500 companies in our hosting environment today, and this represents over 40,000 employees, many of them small businesses like you. We've been growing over the last 5 years. We've been on the Inc. 5000 list for the 5 consecutive years, but what we're really proud of is that 30 companies, 30 of our clients are also on the Inc. 5000 list this year. So that's enough about us. What we'd like to do is learn a little bit more about you. So I'm going to take a little poll, and we're going to launch the poll. So, you're attending this webinar about direct versus indirect costs. So we want to understand, what are some of the biggest challenges that you're facing for accounting? Are pricing out your proposals a challenge for you, making sure they're accurate and compliant? And I know often you're also racing against the gun to get them out on time. So, not only are they accurate, but can you get it done in time? Is there challenges with your accounting system? It's just not adequate for your needs. What about your project costs? Are you getting the visibility you need into your project costs so you can deliver on budget? And do you have the staff that have the accounting expertise to run all this? Please feel free to check off as many as you want, and because this will help us to get a better sense of who you are, so that Sean can do a better job of delivering content to you today. I'm going to allow a few more seconds. 5, 4, 3, 2, 1. Let's close the poll, and let's share the results. Okay. So some of you, the number one answer was that you have your accounting staff doesn't quite have the expertise. And certainly, Sean will be able to help you out today, give you some education on how to allocate costs and things like that. And not surprising also, number two, a close second there is pricing out your proposals. I know that's very important to government contractors because you want to price low enough to win, but also price high enough that you can deliver profitably. So some, unsurprising answers there. So gives us good sense, and Sean, I hope that helps you to understand this audience so you can tailor some of your comments to it. I keep mentioning Sean here, and Sean Chen is our Vice President of Client Services. He has over 18 years of experience in accounting and financial management roles, specifically with government contractors. He's responsible for delivering financial management advice, as well as overseeing the day-to-day accounting operations for our government contracting clients. Sean, let me turn it over to you.
Thank you, Brian, for the introduction, and thank you all for joining us. We have a lot of material to get through today, and I know everyone has a busy schedule, so we'll go ahead and dive right in. So under the cost and pricing principles, there are two basic groups of costs within government contracting, direct costs and indirect costs. Direct costs, and we'll go more in depth in direct costs a little bit later in the slide, but direct costs include all of your billable labor, all of your subcontractor costs that are associated with a particular contract, travel that's associated with contracts, and consultants and other direct costs or ODCs. Indirect costs will be anything that is not associated with a particular final cost objective. So if you can't charge it to the project, or if it's an operating cost within your company, it's considered an indirect cost. So knowing the difference will affect on how you price. Notice that a lot of you had checked the pricing poll answer there. It'll also affect the operations, how you invoice, and how fast and quickly you can get paid. And the most important piece for government contractors is it'll affect winning new business. So with that, knowing the difference between a direct cost and an indirect cost is key in government contracting, especially if you already know what's a direct and indirect cost. Sometimes misrepresenting costs can lead to penalties, such as fines by the government, imprisonment, although that's very, very rare. An example I want to give you is that a company that we know actually charged the government for purchasing a home, and they put that home as a purchase on their books. It was a recoverable cost, and they were billing the government knowing fully that they basically bought a house within their company and charged the government for it. That's an example of where, okay, imprisonment can actually be in the conversation. But ultimately, if you do misrepresent costs and you're making false writing or documentation concerning all of your costs that are being incurred to your company, the biggest factor is that you'll lose that ability to contract with the government. It'll be very difficult for you as a company to win new work. So the definition of direct costs, it is found in the FAR 31.202, and direct costs are any costs which is identified specifically with a cost objective on a contract. They are also charged directly to the contract and cannot have been included in any indirect cost pool. So examples, again, of direct costs are all of your direct labor or your billable labor, direct travel associated with a particular contract, any consultants or 1099 employees that you use that are working on a particular project, all of your subcontractor costs, and same thing with materials. Now, some exceptions to a direct cost rule would be, and this would be really for more advanced, smaller type government contractors, is that if you have a contract administrator or if you have an accountant that actually does billing and also communicates with the contracting officer or has some type of workload that's associated with the project, okay? And in an effort to lower your G&A, which most small government contractors struggle with, they struggle with high G&A, you can charge some of that indirect labor to a non-billable labor category to the contract. It'll lower profitability on paper, but what that essentially does is that it removes that administrative labor out of your G&A pool, puts it into a direct cost, even though it's not billable, but it'll lower your G&A rate. So that's an exception there. So under the indirect costs found in the FAR 31.203 is a cost not directly identified with a single final cost objective, but it's identified with two or more final cost objectives, meaning that if you order office supplies, you might order office supplies and paper that would be associated with multiple projects, but you can't bill or you can't invoice that particular supply. So you would actually charge it to overhead. Same thing with like a rent, right? If you have rent for your office and you know that it's there to support the projects themselves, you can't charge rent to the government. What you can do, and that's why indirect costs are so important, is that it basically factors in a rate where it's recoverable. So even though you spend $10,000 a month on rent for your company, through the calculation of your overhead rate, you're able to bill that calculation or that percentage back to the government or factor those percentages in when you're pricing out an RFP. And that's why indirect costs are so key to ensuring that you're in line and that you're competitive so that you're able to bill the government back for those costs. So some of the indirect costs and rate calculation, we're going to get into some indirect cost buckets. The three that are most common for government contractors are your fringe benefits, which are all of your health insurance type costs, your dental insurance, 401k matching, vacation accruals, if you have sick leave, all those items such as holiday all fall under the fringe benefits. Overhead costs are some of the things that we've already talked about: office supplies, postage and handling, rent, depreciation on your fixed assets, and then G&A. Sometimes companies don't know whether a cost is G&A or if it's overhead. And a simple way to identify a G&A cost is that it's a cost on a corporate level. So basically to keep the company up and running. So your legal costs, your BPOL taxes, all of your executive management labor, such as VPs, business development type folks, accounting folks, HR folks can all charge and will be placed under the G&A bucket. And then, as you can see, the rate calculation is below. And once you're able to identify what your indirect cost base is and what your indirect cost pool is, and ensuring that the two are consistent throughout your company, you're able to develop an indirect rate. Now, some accounting systems such as a Deltek GCS or a Deltek cost point, even a JAMIS, a SIMPAC, and there are add-ons for QuickBooks, will be able to calculate this indirect rate for you, as long as you have identified what's in the cost base and what's in the cost pool. So going back on the three main indirect cost pools, we'll go into Fringe first. And as I said before, Fringe cost benefits are any employer-paid type payroll tax, your FICA, your FUTA, employer-provided insurance, your health insurance, your vision, your dental, all of your paid time off, and other employee benefits such as the tuition reimbursement or employee morale. All of those type of costs will fall under your Fringe benefit costs. Other examples of your cost pool, again, are the employer portion of the FICA, which includes Social Security and Medicare, all of your federal and state unemployment insurance, your workers' comp insurance, holiday, 401k, matching, and your bonus payouts. Now, the bonus payouts have an asterisk by it because depending on your company, and the key with the government is all about consistency, okay? So if you decide to keep bonus payouts in Fringe, leave it in Fringe. Don't take it out of Fringe because maybe Fringe is a little high, or if you have it in G&A as a bonus payout and you notice that your G&A is non-competitive now, don't move it out of G&A into Fringe. Be consistent with variable items such as a bonus payout, because I've seen them in overhead, I've seen them in Fringe, and I've seen them in G&A. But one thing that we tell our clients is it's all about consistency. So if you have it in G&A, leave it in G&A.
Hey, Sean, just to interrupt you, if you haven't put it anywhere yet, if you're just setting up and everything, is there a place where you would recommend putting it, or is it really case by case?
Well, so that's a good question. For anyone that doesn't have a bonus account, the government loves to see Fringe rates, okay? And this is a little type secret for you all. The higher the Fringe rate, the better it is for the government, because they look at the Fringe rate as, hey, this employee cares about, this company cares about their employees. They're willing to take care of them. Higher Fringe rates, for instance, hey, we pay all of our insurance, all of the insurance for the employees. That's going to jack up your Fringe rate, but the government loves to see that, okay? So my advice is to stick your bonus payouts into Fringe. What the government doesn't like is high G&A. So to them, that means essentially you have too many chiefs and not enough Indians running the business, and the government doesn't want to pay for that. So that's just a little secret for you all that don't know. So all of your Fringe benefits cost base would include, and again, this is the base, okay? So would include all of your productive labor. So that includes all of your overhead labor, your G&A labor, your B&P labor, if you have research and development labor, and obviously all of your billable labor. So next thing we'll get into are the overhead costs. And again, all overhead costs are, again, not charged directly to a contract. These costs are typically incurred for more than one contract and are in support of contracts, i.e. the office supplies, the postage and handling, the rent. So the overhead cost pool, again, this is the pool, includes all of the indirect labor and supervision. So sometimes in most companies, they'll have a project manager. Project managers sometimes carry a corporate title and sometimes wear a hat that are strictly for contracts. So when that hat is on for contracts, then most of the time, if they're reviewing items that aren't billable or that aren't able to charge to a contract, they'll be charging to the overhead indirect labor. Also, employee-related expenses such as training costs, indirect travel that's not billable, and then again some of the materials, which are the office supplies and postage and shipping. Again, on the fixed charges, I've seen where they are in overhead and in G&A, such as depreciation and rent. We recommend that companies, bottom line, okay, you just want to keep your G&A as low as possible. Again, the government doesn't like high G&A. If you're submitting an RFP and it has a G&A of over 15%, 30%, 20%, chances are you're not going to win that work, okay? So the lower the G&A, the better for you as a company. So if you currently have fixed charges such as depreciation and rent and G&A, I would highly suggest you move them out. Develop a policy, develop a procedure so that it's in writing, and then move those charges out of your G&A and into the overhead. Same thing with all of your utilities. I've seen startup companies where they said, I'll just dump this in G&A, really not understanding what the G&A pool does. So if you have utility type costs in your G&A pool, develop a policy, develop a procedure, move those costs out into your overhead. So the typical overhead cost base is all of your direct labor dollars, okay, plus the fringe benefits on top of, plus the fringe rate on top of those direct labor dollars. I'm not really going to go into a manufacturing business, as most of the businesses here that are government contractors are service-based, but manufacturing business overhead costs are pretty complex, and there are additional variables used as a base cost. So your G&A costs, again, a simple way to put it is that it's for the corporation. So any general management, financial, administration, and other expense that's incurred for the benefit of the corporation as a whole, such as your administrative and executive expenses. If you have a board of directors, those minutes are charged to your G&A cost pool. All of your legal setup, all of your accounting functions, public relations, financial services, marketing, even though marketing can be considered unallowable, some marketing is G&A, all of your business insurance, your taxes such as BPOL, all of your IR&D labor, your bid and proposal labor, and other miscellaneous type corporate stuff. So your cost base for the G&A is basically a TCI, or your total cost input. So that includes everything within the company, excluding your G&A expenses. So examples are all your direct costs, all of your fringe costs, and all of your overhead costs combined make up your G&A cost base. Now, as you grow as your company grows and you're taking on multiple subcontractor costs, let's say, and you're going after a lot of prime work, there's actually other rates that you can develop other than a G&A rate. Although it'll hurt your G&A rate, you can develop a sub-K handling rate or a material handling rate that separates out sub-costs, so that it gives basically the government a discount for those sub-costs that you're incurring. So instead of charging the government 10% or 12% on subcontractor costs that would normally reside in your G&A pool, you could carve those costs out, create a sub-K handling fee, and charge the government only 3%. I mean, those are pretty advanced type things for companies that are already established. But for now, again, trying to keep your G&A rate, I can tell you between an 8 to a 12% G&A rate is right about the range where you want to be in. So once you're able to figure out what your direct costs are, what your indirect costs are, once you're able to calculate a fringe rate, calculate an overhead rate and a G&A rate, and you know it's correct, then you're ready to actually price out a labor cost or price out services and ensure that, okay, if I'm pricing this out because of my records are accurate, I know I'm going to make money off of this employee or this type of service, okay? So with the example that you see here is that a salaried employee of $100,000, if you divide that by 2080, you come up with a raw labor rate of $48.08. Now, how you build this up for cost proposals or even for internal uses to understand profitability is that you take your fringe rate, and this example is 32%. So 32% of the $48 is $15.39. You do the same thing with the fringe, same thing with the overhead, and then you calculate in G&A. So the calculation, though, is the following. So you take your direct labor times your fringe rate, and you add in the two. And then once you add in the $48 and the $15, then you multiply your overhead rate, and you combine all three of those, and you multiply your G&A rate to come up with the total cost of the employee, okay? And in this case, it's basically $85 to keep the employee within your company. So that's a break-even point for you. For you as a company is the $85. So as you can see, what you're hiring the employee for is $48, but really what it costs you as a company to keep the employee working is really $85. So now you want to make some money off the employee, and you add in an extra 10% fee on top of that, which is an extra $8.50. Now you can establish a total bill rate for the employee, which is $93.48. That's how you build a rate, and that's how you're able to determine if you're profitable or how much profit you're making off an employee. So once you're able to establish your fringe, your overhead, and your G&A, and you're able to come up with a particular bill rate, and you're using that bill rate and that rate buildup on an RFP, the next thing the government's going to do is come back and says, well, how did you get to this number? Did you just pull it out of a hat? Do you have a spreadsheet that has the calculations? And do you have the supporting schedules that show the fringe cost, the overhead, and the G&A? So those are all very important things to have when you do submit an RFP. You know, what are your supporting schedules? How many spreadsheets do you have? And if you have spreadsheets, what reports are you using those numbers from? And again, do you have written descriptions? Anytime you're in government contracting, policies and procedures are the number one thing to have because it backs up everything that you're doing and you're submitting to the government. So having written policies and procedures for essentially every aspect of your company is key in government contracting, and that's what we tell all of our clients. So have a detailed explanation of how costs are classified and accounted for and how indirect rates are calculated. And keys to cover yourself, get everything in writing, from amendments to RFPs to modifications of existing contracts, administrative type changes to existing contracts. Brief your contracts. Make sure that you have a contract folder with a cover sheet that shows who's authorized to work on it, what the period of performance is, what the initial funding levels were, all of that stuff. Exclude unallowable costs from submissions, such as alcohol, exorbitant parties. Don't include those as costs that you want to bill the government. Make sure that you understand what an unallowable cost is, and make sure that you separate those out of your normal day-to-day operating costs. Provide support for all of your costs, again, on the spreadsheets, the reports, written policies and procedures, and most importantly, notify your contracting officer, or if you have a DCA representative, of any policy changes within the company. Some more keys: report any updated file, updated info to final negotiation. So what that really means is, you know, hey, in the previous RFP, you see a 35% fringe. Well, you know, we just incurred a whole bunch of people, and we've changed our fringe benefits, and now our fringe benefit goes up to 45%. You know, update and report that to anyone who is on a need-to-know basis on that. Again, it's consistency. Consistency is key in government contracting. Maintain files on activity after award, which is your contract folder. Use FAR as a guide. I know FAR is a really joy to read, but you know, at least have that as something in the background for you to reference if you ever have any kind of questions on that. And then in bold, an adequate accounting system. Now, QuickBooks, Peachtree, out of the box, those aren't adequate accounting systems really to do business with the government. However, there are certain add-ons and structures that you can use when setting up your QuickBooks or Peachtree system that could be deemed adequate by DCA. So a little bit on the limitations of QuickBooks. Again, you know, QuickBooks and Peachtree, you're able to modify close months, meaning that if, for instance, we're in January now, and if you miss something or if your numbers don't look right for December and you need to give it to the bank, you need to give it to a CPA, or you just need to give your financials to SBA, well, guess what? You can go back into QuickBooks. You can make any adjustment in any type of month that you want, and it'll spit out a new financials for you for the month of December and year to date. So, and once that happens, what the government looks at is, well, if you can do that for your CPA or your bank, why wouldn't you be able to do that for us? So most compliance systems really need a hard close, and what a hard close means is that once you've completed a month and you've already produced monthly financials, you literally can't go back into that particular month, open it up, make some changes, close it again, and then produce new financials. So the government wants to see, okay, you've closed this month, here are your financials for that particular month. Oh, if you need to make changes to any prior month, you do it in the current month so that they can see that audit trail and see the reasoning for changes, okay? It also provides, QuickBooks and Peachtree also provide kind of inadequate reporting. Again, you can modify costs after generating invoices, and those are red flags for audits. So if you, a perfect example is this, is that the reason why DCA conducts timesheet audits is for this very reason, so that one month your employee might be charging to a contract, the PM or yourself looks at the funding levels and realize that, oh, we've gone over funding, but we have more funding on a different task. Well, let's have, we've already invoiced for his or her time, realize that we've gone over funding, so now we're going to move that employee's hours into a new task that has more funding, okay? Depending on the contract terms, that's a red flag. Just because there's no funding on a particular task, even though that employee is working based on the scope of work under that task, he can't just move it out of one task to another because of funding issues, okay? So that's kind of where the inadequacies come in with a QuickBooks or Peachtree type system. With a Deltek type system or any other kind of sophisticated or government contracting type accounting system, you know, any type of change like that within your labor timesheets will require an explanation and will require signature and approvals. And the last thing is lack of automatic rate calculations. Most of the folks that are on QuickBooks rely on Excel spreadsheets. that they've developed, and sometimes they can be complex and obviously are error-prone with any spreadsheets. So with that, I want to say thank you again for attending the webinar, and I'll go ahead and turn it over to Brian for him to wrap things up, and then I'll get to the questions after.
Great, thanks, Sean. And as Sean mentioned, we're going to get to your questions in just a second, and I'm thrilled to see we're already getting questions coming in. So if you have questions, please start typing them into the question box. Quick recap, we had today's session on direct versus indirect rates. We're going to have 3 more webinars just like this, one on contract types and pricing on February 18th, understanding DCAA on March 10th, and cash management on April 16th. And all these webinars are free, so please feel free to register for them. And then we're going to do the workshop with SCORE at their SCORE offices on April 22nd. I believe SCORE does charge a nominal fee for that, so but all that money goes to SCORE. So they're a nonprofit and they've got to keep their lights on and doors open. So, and it is a very nominal fee. So those are just what's coming up in the GovCon 101 series. And now we have other resources available to you. I saw something about unallowable costs. There's some references in here that you can tap into to get to those, and maybe I'm stealing the thunder here. So we'll get to those in just a moment. And other resources available to you. We also have our training courses that we offer here. We also have a blog center, and where we, as issues come up, Sean was telling one story, sometimes different stories come up, and we write stories, and we tell you what's going on in the world, and we tie in what the best practices are around those mini case studies, if you would. If you have other questions, you can email us at growahead@neosystemscorp.com. And now I want to open up for one final poll. And so we're going to launch that poll, get a little more understanding of, now that we've kind of done this webinar, get a little more insight into you. If you're using QuickBooks, what are some of the biggest challenges you're facing? Sean mentioned the automatic rate calculations. Has that been a challenge for you? The lack of GovCon-centric reporting, as many of you know, the government does want specific reports, but especially those job status reports, let you know where you are in your project and your funding. So is that a challenge for you in making sure you can deliver on budget? Maybe you're not on QuickBooks or Peachtree. Maybe you're using Deltek already. But if you're having some issues with it, let us know. Or you're using another accounting application altogether. That kind of thing covers the universe of everybody out there. So you could complete the poll and give us a sense of what you're finding out there and what your experiences are. I see a lot of people still answering, so I'm going to keep the poll open for another 5 seconds. 4, 3, 2, 1. Please close the poll. Let's share the results. Okay. Not the rate calculations is tied with, we got a lot of people out there using another application. So as not surprising though, those rate calculations are an important issue for people, and not being able to get the visibility into their job status reports, things like that. Another GovCon-centric reporting, second place. If you are using another accounting application, I'd really love it if you would just, I guess you could put it in the question box, just write what you're using, so we get to know you better. So as we go into the follow-on webinars, we can have a better sense of what our audience is using out there. That'll help us to refine our commentary, and also Sean can add some perspectives on all of that. Okay, now I'd like to move on and open it up to your questions. So if you could, any questions you have, please type them into the question box. And just to let you know, we will be making the slides available for people.
All right, so let's get through some of the questions here. One of the questions, does the government provide a list of unallowable indirect costs? The answer is yes. You can actually just go to the FAR website, or if you have, a FAR in there right now, you can just type in unallowable as a search, and it'll give you those sections. I think it's in 30.204 or somewhere around those lines. But yeah, it does have a list of unallowable costs. The next question is, if award is based on the lowest technical acceptable price or LPTA, is it advisable to factor in all applicable direct and indirect costs into the proposal before submitting an RFP or after the winning the bid at a low price? So LPTA is actually an interesting animal, and I'm sure that some of you all have encountered this already. It's a tough environment out there because as a small business, if you're going after some LPTA type work, one of the things that you will always encounter are bigger companies able to do more things with their direct and indirect costs. Okay, and what I can tell you is that the best thing to do, and we'll get into pricing in the next webinar and upcoming webinars. We have a lot on positioning yourself to win an RFP, how to win an RFP, and that sort of thing. What I can tell you, the best advice from me is to develop some forecast tools, which would give you what-if scenarios, and you're able to factor in existing costs plus costs that you're going to be incurring if you win the RFP. Okay, so essentially it's called forward pricing, but it's not quote-unquote forward pricing. All right, the government uses it for one term, but essentially you are forward pricing. So that's the best advice that I can give you, is to forecast out what your company will look like if you were to win new work that includes 20 or 30 people. Okay, so next.
Did you answer that one? Is there a FAR?
Yeah, I think there is. I'm pretty sure there is.
Or we should write one if there is.
Maybe just go to Amazon. But any type of listen. If you all have any other questions that you want to discuss offline, please feel free to email either myself or Brian, and we can answer those questions more in depth. The next question is, if a company has 3 to 5 years of financial data in QuickBooks, is it easy to migrate the data into Deltek, assuming the cost control accounts have been set up and maintained consistently? The short answer is yes. It's pretty easy. Even if you were to migrate into a GCS system mid-year, what we would do is that we would take your beginning balances within your balance sheet, upload those as of a particular time frame. So it will always be a cutoff at the end of the month, okay? And then we would load in your existing data as of a 30 or the last day of a month. So those would all be your beginning balances going forward, so that your income statement and your balance sheet continue to be correct. And how we would deal with contract costs, it would be, we would ask for all of your contracts that obviously aren't classified, being able to take a look at the funding, the period of performance, how many hours have been incurred, what's been billed, what hasn't been billed, what the revenue is, and we would go ahead and upload those so that you would have visibility into your project costs. So the short answer, again, is yes, it's actually very easy. We have, that's what we do. We do a lot of GCS implementations, and we do a lot of cost point implementations.
Sean, yeah, there's a couple of questions on the wrap rate. I know you walked through it, but maybe you could just kind of walk through it one more time quickly to allow to answer that question. How do you calculate wrap rate?
Sure. So wrap rate is a very quick way to figure out right away what it's going to cost your company. So it would be a burden rate. So it's by percentages. So you just want to basically put 100 in front of each. So if your fringe rate is 35%, you want to calculate it as 1.35 times, let's say your overhead rate is 15%, then you want to do times 1.15, and then whatever your G&A rate is, the same thing. And that's how you'll come up with a wrap rate.
So that's what gets you to those numbers like we saw before, the 1.8 or whatever it was.
Right.
Somebody's looking for some resources for understanding unallowable costs. Can you point them in a good direction there?
Yeah, again, it's you can go on the FAR or DCA website, and you can type in unallowable as a search, and it'll guide you to where you need to go. So let's see. I'm trying to read through the questions here.
Yeah,
somebody's
asking about material and handling pools. I think that one might be better off to take offline. It's rather specific if you're looking for how to do material and handling rates.
So, so any key advice for setting up a M&H pool? Well, you would have to, again, anytime you're going to set up a new pool for anything, whether you want to set up a management fringe pool, whether you want to set up a on-site, off-site overhead pool, the key is to figure out what you're trying to accomplish. Once that's done, establish a policy, establish a procedure, and then set up your GL so that it's clearly identified, okay, these GL accounts are specifically for my M&H pool, and then create direct cost buckets if you don't already have it for your subcontractor costs, for your consultant costs, and then move those costs into the appropriate bucket. So for your pool, for instance, all of your material handling labor, right? So one of the pitfalls that I see is that, hey, my G&A rate is too high. Let me move some of my labor into the M&H labor. I mean, that's, you're going to have some of those instances. So again, when you establish those policies and procedures, you have those in place. As long as you follow those, you won't get into any kind of issues with DCA. All right.
Lots of people asking about the presentation again. If you're interested in getting a copy of the presentation, just put in the question box, yes, I'd like a copy, and we'll be sure to get you one.
Okay. So then one of the last questions, I think we have one or two more. We'll do two more. So when you use 2080, he's talking about hours for labor and apply the 32% fringe. Does the 32% have fringe vacation PTO included? I have seen some companies use another base, 1880, 1960, et cetera, to reduce the 2080 for the fringe time. So the 2080 is really to establish, again, what your raw hourly rate is for your employee. Now, once you can figure out what that hourly rate is, that's how you're going to establish your actual fringe rate or your raw labor for your employee, okay? Under an RFP conditions, though, they can be different. They can be completely different. So sometimes RFPs will state, or that you as a company said that, even though the RFP says 1,800 hours to get the job done for one person, you might propose 1,600 hours that you can get the job done. So then the hourly rate calculation would be different, okay? Those are things that really I can't get into over this Q&A type session, but that's actually a very good question. So for the 2080, that's establishing what your actually raw labor is that you offer the employee. Now, if you're talking about RFP items, there are multiple variables and avenues that you can take to make pricing better.
Yeah, so if I was thinking about that, I'm really glad, because when I first read that question, I was like, gosh, I'm glad Sean's here. And now I get it with the 2080 hours, you have, say I made $1 an hour, okay, all my labor costs would be $2,080, and some of that would be direct labor, some of that would be my vacation time, some of that would be my holiday time, and those holiday and vacation dollars would go into the fringe rate. That makes a lot of sense. Thanks, Sean.
Right.
That that clarified it a lot for me.
So the final two questions are wrapped up into basically one. So what types of accounts are specific to all companies, and how do you know what pools accounts to set up for new businesses? So one way to set up accounts and set up infrastructure to conduct government contracting is to think 5 years ahead, okay, and don't think in the now. So if you were a DCA auditor and you wanted to come in and take a look at your own books, right, you would want things structured so that it'd be easy to read, just like anyone else. So what we tell companies is to set up your company so that it's easy for an auditor to read, or it's easy for the government to look at, and they don't have to spend hours upon hours trying to figure out what's going on. So for instance, if you have QuickBooks, set up all of your Fringe accounts as 5,000 accounts, for instance, or 0500 type accounts. All of your overhead as 06 or 6,000 accounts. G&A as 7s or 8,000 accounts, okay? So that way they're clearly identified blocks of accounts for each one of your indirect cost pools. Once you're able to establish that, then you don't have to go peck and choose, well, which one is overhead, which one is G&A, just by the description of the account, okay? So as you're conducting business, day-to-day business, and time goes on, you're always going to have that structure so that when you do incur a new overhead cost or a new G&A cost, you know exactly where to put it, all right? So that's the easiest answer. Let's see if we can take one more. Is there one more? Okay.
Okay. So that was great, Sean. I really appreciate you spending the time here, walking through this, and I appreciate everybody taking the time out of their busy days to join us for our webinar today, the first in our GovCon 101 series that we're doing with SCORE. And we'll be following up with all of you. For those of you who requested, we'll be getting you a copy of today's presentation. And on behalf of NeoSystems and SCORE, thank you for joining us today.